You're listening to Indications by the Conference Board.
Hello, welcome to Indications. I'm Elizabeth Crofoot, Senior Economist at the Conference Board. You're listening to the U.S. Labor Market Roundup, our monthly podcast series where our labor market experts give you their reading of the latest jobs report released by the Bureau of Labor Statistics, and then provide insights on a special labor market topic. Today, we'll react to the August jobs report and we'll discuss how employers have adjusted their salary budgets for 2020 and their expected budgets for 2021 in response to the pandemic. We'll also touch on some other important salary and wage trends that are starting to unfold. Today, I'm joined by my two regular guests and colleagues. First, Gad Levanon, head of our Labor Markets Institute. Gad is our resident expert on U.S. labor markets, a contributor in Forbes, CNN Business, and other news outlets, and is a co-author of our upcoming report, which we've entitled Salary Increase Budgets, A Wage Crunch is Coming, but It's Delayed. I'm also joined by Frank Steemers, economist at the Conference Board. Frank is also a co-author of our upcoming Salary Increase Budgets report and is one of our primary researchers focusing on U.S. and global labor markets. Gad and Frank, thanks for being here.
Thank you, Elizabeth. Pleasure.
Thank you, Elizabeth.
Great. So let's dig into this jobs report that came out. We saw some really positive numbers for the last month. So U.S. employers added 1.4 million jobs in August, and unemployment declined to 8.4% from 10.2% in July. And that's also down from a high of 14.7% at the height of the shutdowns in April. Labor force participation rate also ticked up, so more people are returning to the workforce, and more of those people are landing jobs, which also contributed to the decline in the unemployment rate. And this last monthly decline is actually the second largest decline on record. So we're definitely moving in the right direction, and I don't want to downplay how important this is for the ongoing recovery. So this particular report is definitely worth celebrating. So with that said, there are still some signs of fragility in the labor market, especially when you start looking under the hood. For example, out of the 22 million jobs that we lost during March and April, we've only regained a little under half of those between May and August. And some sectors are doing a little bit better than others, and Frank will help us walk through some of those results shortly. In terms of furloughs, that's something we've all been hearing about. While the number of workers on temporary layoff continues to decline, which is great news, the number of workers that have been permanently laid off has been on the rise since April. And as a result, long-term unemployment is also on the rise. So 60% of unemployed workers have been unemployed for over 15 weeks, and that's up from 49% in July. So the longer workers are unemployed, the harder it is for them to find a job, and skill atrophy starts to set in. So it's a looming issue that we're going to want to keep our eye on as we move forward. In terms of some of the disparities that we're seeing in the labor market, we know that one of the main themes we've seen in this recovery is really the unevenness that different demographic groups have been experiencing in their own personal economies. So, for example, Hispanics actually saw some good news. They had the largest drop in the unemployment rate out of all the racial groups, down over 2 percentage points to 10.5%. But the decline for white workers was still larger than for Blacks and Asians. So whites are seeing a 7.3% unemployment rate versus Asians at 10.7%, and that's comparable to the rate for Hispanics that I just mentioned. And Blacks have the highest unemployment rate of all these racial groups at 13%. So that's almost 6 percentage points higher than for whites. So we're still seeing a lot of disparities in that sense. In terms of men and women, we're seeing a little bit better catch-up of women in terms of the unemployment rate. Their rate is at 8.6% versus 8.3% for men. So women are starting to claw back some of those job losses they saw earlier. So again, we've seen some really good headline numbers and we're moving in the right direction. But since we had dug ourselves into such a deep hole during the height of the pandemic, we still have a really long way to go. So with that set up, let's turn to our panel and start discussing some of the issues or highlights that we've seen with this latest jobs report. So Gad, I'll turn to you first. Earlier this summer, we and many other economists as well were projecting double-digit unemployment rates until the end of the year. And now we're seeing single digits, which is definitely a welcome surprise. So how did we get down to 8.4% unemployment when we were expecting things to be so much worse? And is this pace of recovery sustainable?
Thank you, Elizabeth. Well, just on a technical point before I answer your question, I think even though the published unemployment rate is 8.4%, the actual true unemployment rate, I think, is 9.1%. The Bureau of Labor Statistics admitted that there is a miscalculation error, but 9.1 is still well below what we expected to have. And I think one of the main reasons for the better trajectory is that when we became more pessimistic, that was because in the early summer we've seen a spike in the cases of in COVID cases. We expected this spike to continue unless the state and local governments significantly restrict the opening of the economy. But they restricted it a little more, but not significantly, and that was enough to stop the further increase in the number of new cases. So the reopening was more successful than many expected. In many of the industries that are impacted by social distancing, they kept on growing through August, and I think that's part of it. And also the less spreading of the virus also makes consumers more willing to go out and about and spend money. So that also contributed to the improvement in the labor market. Now, how sustainable it is, it's probably, if I had to forecast, I would say that the job growth in the coming months for the rest of 2020 is likely to be lower than in recent months, perhaps significantly lower, partly because a lot of what is going to open up already opened up. But also, unfortunately, from the government stimulus perspective, which was a very important part of the recovery so far, it's now much smaller than it used to be before August. We have a great uncertainty about what, if and what kind of deal will be brokered between the Republicans and the Democrats, but the best bet is that it's going to be, if something happens, it's going to be much less generous than what we had before. And a lot of families' consumption relies heavily on that, and we may see more frugality and less spending than otherwise, and that could also slow down the labor market.
Right, and to your point about a lot of the lockdowns have been eased already. That means that a lot of those easy job gains, we've already seen that. So in future months, we do expect that job gains are going to be smaller and smaller. And what you mentioned with sort of that fiscal stimulus, a lot of those companies, especially small businesses, have seen the funds that they gained through, for example, the PPP program, have basically been used up. So we may see a lot of looming bankruptcies going forward. So that will also affect the employment outlook into the fall. Frank, a lot of this really depends on what sector you're in too, right? Certain industries are faring a little bit better than others. Can you tell us about, what are some of the specific areas where maybe some sectors have seen some better employment gains than others, and how does that bode for, the coming months in terms of the employment outlook?
Right. So if you look across industries, there's still the industries that we saw in the beginning that had the strongest job losses. There's still often not that much recovery. So think of performing arts, spectator sports, accommodation. They had declines of almost 40% in employment compared to their February levels. A very little improvement so far. Where we see some more improvement is amusement, gambling, recreation. We know that some more outdoor activity is now possible. Still far from, still 30% below their levels in February. Also in museums, air transportation, very little improvement. Food services and drinking places, there we have seen actually quite some improvement. Still, I think 20% below February levels. But this industry is definitely something we will be closely watching, because we know that there is now more outdoor dining possible. But what will happen when we go into the fall or into the winter? We know, for example, in New York City, they are now having plans to allow some limited indoor dining. But I'm especially curious what will happen to this industry, because we know that they are the first probably to close down if the virus starts to spread again. So I think that this industry, food services, drinking places, will still be at a lot of risk of further job growth. Maybe manufacturing and construction, they didn't decline too much relatively to the hardest hit industries, and have actually experienced some recovery since April. And I had maybe expected them to do a little worse, maybe to already see some lower demand from consumers and other businesses, resulting in lower employment growth for manufacturing and construction, what we often see in other recessions. But this hasn't happened, at least not yet. So I think that are some of the most important points. But maybe let me add that offices of dentists is very interesting. They had a huge decline in employment, but almost fully bounced back. And maybe if we look at the finance and professional services industry, that industry has been very impacted by the COVID-19 pandemic crisis. So not a big decline in employment, and therefore also not huge improvements that were necessary.
Right. I think over this long period from April to August, there is quite a bit of disparity into the experience of different sectors. But when you look at just the latest August jobs report, what I thought was really surprising is that across the board, all these industries really saw increases in employment, and that's largely a function of this summer months and being able to more easily social distance and employ more workers, because companies are able to engage in more business because of that. So again, like you said, it'll be interesting to see what happens in the fall as things start to change a little bit. Another industry I'll mention quickly to keep a lookout is air transportation. A lot of those major airline carriers have announced that they're going to be laying off workers starting in October. And that's after their obligation to keep workers on their payroll ends. And that was in exchange for the government relief funds that they received. So that sector in particular has a lot of risk of seeing employment drop off. So I think that was a really good overview of what we've seen in the jobs report and in these specific sectors and what we can expect in the coming months. So we're going to stop briefly here for some announcements from the conference board, but stick with us and we'll be back to discuss our special topic for this month, the delayed wage crunch.
Can you, your team, or your company benefit from insights such as the ones provided in this podcast? They are immediately available when you join the Conference Board, a membership-based think tank that delivers trusted insights for what's ahead. Reaching across industries and geographies, we bring together our noted experts, senior executives from the world's largest companies, and nonpartisan practical research to help you address your most important business issues. Our membership packages are tailored to your organization's unique needs and budget. To learn more about our offerings, go to www.conferenceboard.org and click Join on the top bar to connect with one of our product specialists.
This is Indications, and you're listening to the U.S. Labor Market Roundup, focusing on the August jobs report. We're now going to shift gears to our special topic on the delayed wage crunch. So even though we've started to see some signs of recovery, we know that we're still in the midst of this historically weak labor market. One lever that employers have to try to survive a period of low demand, such as this pandemic that we're all in, is to adjust the number of workers on their payrolls. And we've seen this play out already in the BLS jobs reports over the last several months, and in the number of temporary furloughs, and now the rising number of permanent layoffs. The other lever that employers have is to adjust their compensation costs, and that includes wages and salaries. So today, Gad and Frank are going to share with us some of the findings from the Conference Board annual Salary Increase Budget Survey. So this survey was fielded this year between April and June, and we asked compensation executives from over 180 organizations about two main components of compensation. The first is salary structure movements, and the second is salary increase budgets, which are a measure of the average raises that we see within a company. We'll also discuss other salary and wage trends that businesses really should be paying attention to right now. So first of all, Frank, can you briefly remind us about some of the tactics that employers have been using throughout this pandemic to reduce their labor costs for their existing workers?
Yeah, right. So, of course, we know that there have been many furloughs. Companies have been reducing hours, layoffs, of course, which have been increasing, as you mentioned. But, of course, also a few directly related to compensation. So we actually fielded a survey last April where we asked what companies were doing. And back then, already 40% said that they had already deferred some pay increases and bonuses, or they were thinking of doing that between May and July. Cutting bonuses, actually 30% of companies had already done that in April, or were expecting to do so between May and July. And cutting salaries was about 20% that already had done this or were thinking of doing this. So I think that there are a few things that companies have already been doing.
So obviously, companies are having to make some really tough choices right now regarding worker compensation. And workers are starting to really feel the effects of this reduced wages and incomes, cuts and bonuses, like you mentioned. So, Gad, the title of our episode today refers to the delayed wage crunch. So if workers are feeling the effects of these wage and salary cuts now, can you explain why we expect this wage crunch to be delayed?
So, in such a deep recession, eventually wages will be significantly impacted. The reason why it's going to take a little bit time for it to happen is because a lot of the people who are officially unemployed right now, that in normal time would go look for a job and make it easier for companies to recruit and therefore lead to slower wage growth. What's happening now is a little different because a lot of those people who are officially unemployed are not seriously looking for a job. And part of it is because a lot of them are those who are furloughed. They still expect to go back to their old jobs. A lot of people who are afraid of getting infected prefer not to find a job right now. People who don't have solutions for childcare also are not excited about leaving the house and going to work. So, and on top of that, what we had until last month, which was the very generous unemployment benefits, that also probably through July impacted the amount of people who are seriously looking for a job. So for several reasons, the number of people who are seriously looking for a job is much smaller than the number of unemployed, and is not that unusual. Now, this is probably going to change because with the unemployment benefits, that incentive is already mostly gone because the generosity of the unemployment benefit declined significantly. I think a lot of the furloughed people would realize that there is no job waiting for them, and they'll also join the labor market. So I expect when that happens, we will see more competition from workers over jobs and a slower wage growth.
And just a reminder to our listeners that actually during last month's episode of the Labor Market Roundup, we did do an in-depth, dig in as to some of these reasons behind the contradiction that we're seeing with high unemployment rates, but employers having a hard time finding qualified workers. So, definitely suggest that listeners tune back to that episode if they want to hear more about that particular issue. But Frank, I want to turn to you now in terms of our results from our salary increase budget survey. They tell us a lot about how companies are reacting to these downward wage pressures. Can you go into some of the specific results as to how they're adjusting their pay practices, both during the crisis and then looking ahead into 2021?
Yeah, so let me maybe start by giving a little longer definition of the salary increase budgets and salary structure movements or adjustments, because I will be using those, or we use those in the report and also in this podcast. So with salary increase budgets, we mean the pool of money that an organization dedicates to salary increases for the upcoming year. So think of annual pay increases, and then salary structure movements, that refers to the changes to salary structures in a compensation program. So for example, adjustments to minimum, midpoints, maximums of different pay ranges that also take into account what is, for example, happening to the cost of living or what is happening to the salary market within industries. So because the survey, the salary increase budget survey, was fielded between mid-April and mid-June, we actually received a lot of responses from organizations that said that they were still very uncertain what would happen to salary increase budgets. So in terms of exempt employees, non-exempt employees, executive pay, we did already see a decline in salary increase budgets for 2021. But because so many organizations pointed out that they were still uncertain and therefore were not entirely sure if anything would happen, or if the salary increase budget would be lower or would stay the same, we expect that likely it's going to be even lower going into 2021 and 2022. And a similar story for salary structure movements. Also there, we actually didn't see any changes yet, but we expect that there will definitely be a decline going into 2021 and 2022, because it is also what we have seen, or what we saw happening during the Great Recession from 2008 to 2010, when there was a big decline in salary increase budgets and salary structures.
So in addition to some of the wage cutting that we saw that you talked about for existing workers, we're seeing that future pay increases are also going to be adjusted downward. And into 2021, which makes sense with all the financial pressures that companies are seeing right now. Gad, are some of these wage pressures more intense for certain types of workers than others?
Yeah, I think especially when there is a weak labor market and an economic crisis, companies are much more willing to lower wages for new hires than for existing workers. For existing workers, lower wages usually hurt morale, and companies prefer not to do that, but they don't have a problem doing it for the new hires. So expect to see a bigger wage adjustment for new hires, and especially for younger workers, the new entrants to the labor market, because those workers typically see the lowest wage growth, or the largest wage decline during recessions and periods of weak labor market. And this time they may even see take a bigger hit, because the industries that are especially hard hit in this recession tend to hire a lot of young workers. The best example is food services. There are certain jobs within food services where more than 70% of the workers are under the age of 25. So the slow recovery in food services is really hurting younger workers. So we will probably see wage growth they're taking a bigger hit.
Mm-hmm. And one of the main takeaways, at least for me, is this focus on the new college graduates that we've seen. Their experiences has also been upended, and they are now, instead of they were going to come into one of the strongest labor markets that we'd seen in decades, and now they're seeing a completely different reality where they're now not seeing as many employment opportunities, and those employment opportunities, you're saying from our research as well, that they're going to see lower earnings levels because of the current environment that we're in. So I think it doesn't bode well for college graduates trying to find jobs.
Yeah, and it's not every time there's a recession, new college grads suffer, but I think they would suffer less than their friends who don't have a college degree, because a lot of the job losses that we've seen are in types of jobs that don't require a BA. So the abundance of job seekers is going to be even larger, and it would be harder to find a job, and the wage adjustment in those jobs is likely to be larger.
Mm-hmm. So, Frank, we talked earlier about cutting wages and bonuses for existing workers, and now new hires and college graduates and other new entrants into the labor market are going to bear the brunt of this expected wage slowdown. How do these downward wage pressures differ for different types of occupations?
So I think that Gad maybe already talked a little bit about it by discussing the differences between workers with higher education or with a BA or higher and those without a BA. So this is also what we then will likely see happening to different occupations where you generally do not need a BA. So the blue collar workers or the manual services workers, those that have been most impacted by this pandemic crisis, they will likely see the biggest decline in wage growth. And for example, for the management and professional occupations where you generally do need a BA to work in, we do expect also wage growth to decline there, because of course also people are losing jobs in these occupations, but less so than for the other occupations, the manual service and the blue collar workers. So for the management and professional occupations, wage growth will also decline, but not as much as in the other occupations. And let me maybe point out that this is actually also very unfortunate, because just before this crisis hit, the strongest wage growth was actually for blue collar workers and manual services workers. So it is very unfortunate that this came to such a abrupt end, and will likely take a lot of years before the labor market gets tight again for these occupations, and that they can get these same strong wage growth as they had just before this crisis.
And this is just a continuation of that narrative of the different disparities that different groups of workers are seeing, between those that are less educated and more educated. And Gad, part of the current dialogue around social justice more generally and racial inequality also involves labor market outcomes. How do we expect the slowdown in wage growth for younger workers and blue-collar occupations to impact wage inequality?
Yeah, so I think, as Frank mentioned, right before the pandemic, there were several years where the wage inequality was actually declining, which is very unusual in the big picture. And the big picture in recent decades, wage inequality and income inequality are on an upward trend, which didn't happen in, let's say, between 2015 and 2019. But unfortunately now is likely to continue the rise in inequality, and exactly for the same reasons that we discussed, the weaker labor markets for people at the lower end of the income distribution, plus especially focus on young people. And if you look at unemployment by race and ethnicity, you see that I think Frank mentioned earlier, there's a much larger jump in the unemployment rate for minorities than for the white non-Hispanic group. So I think we'll see larger gaps both between income groups and between racial and ethnic groups resulting from this crisis.
Yeah, I think that's very unfortunate how, as Frank was saying earlier, and, another thing I want to bring up is the minimum wage increases that we've seen that sort of counterbalance some of these downward wage pressures, especially for these less well-off demographic groups. So Frank, 2020 has been the year of minimum wage increases. In total, we've had 24 states and 48 localities that have increased their minimum wages, or that will do so by the end of 2020. And this includes 17 cities and counties, especially around the Bay Area and California, where minimum wages will actually reach or exceed $15 an hour. So with the downward pressure on market wages, what are some of the implications for rising minimum wages for both workers and employers?
Right. I think that minimum wages can protect some of the worker pay. Though I wonder what will happen now, because we know that market wages are going down. So in previous years, when minimum wages were increasing, we were in a growing economy. So also market wages were growing. Now I do wonder what will happen, what some employees might decide if minimum wages are rising, but they are really in a lot of trouble. Will they maybe move their operations to a state or locality where minimum wages are lower? Or will they maybe decide to decrease hiring and maybe go for automation if that is possible? In that sense, we're going into some new territory because we're coming out of this crisis and market wages are likely going down.
Right, and some of the issues that you brought up in terms of automation and changing geographies are all aspects that we've seen accelerate, or trends that are accelerating because of this pandemic. So, and that can lead us into another rabbit hole. So I think this is all the time that we really have for today. This has been another enlightening conversation with Gad Levanon and Frank Steemers about the August jobs report and the delayed wage crunch. Gad and Frank, thanks again for being here.
Thank you very much, Elizabeth.
Thank you, Elizabeth.
And thanks to all of you for listening. Please join us for our next month's U.S. Labor Markets Roundup, where we're going to be discussing the September jobs report and our short-term labor market outlook. If you've enjoyed this podcast, please subscribe to Indications. You can find this program and several others from the Conference Board on our website or through your favorite podcast app. Thanks again for listening. I'm Elizabeth Crofoot with the Conference Board.
This has been Indications from the Conference Board.